Nebius just raised $5 billion in convertible debt, and investors were willing to give it even more money than the company originally asked for. The deal was initially planned at $4.5 billion, then expanded because demand was so strong, with an option that could ultimately push the total to $5.75 billion. That would be remarkable for almost any young company. But Nebius is doing this while already carrying roughly $12 billion of convertible debt, spending billions on data centers, and losing money on a traditional accounting basis. So why are investors still willing to finance it? Because Nebius says it has the opposite problem most startups have. It is not struggling to find customers. It is struggling to build AI computing capacity fast enough to serve them. In the second quarter, Nebius generated $582 million in revenue, roughly 5 times what it produced a year earlier. Its core AI cloud business grew almost six-fold. During the quarter, it signed 4 AI cloud contracts averaging more than $1 billion each, while total contract value nearly quadrupled. Management says the company now has more than $40 billion in customer commitments. That sounds like an extraordinary growth story. But there is a catch. To turn those contracts into actual revenue, Nebius first has to build the infrastructure, and that is extremely expensive. Nebius is what the industry increasingly calls a neo-cloud. Instead of competing with Amazon or Microsoft across every type of cloud computing, it focuses heavily on AI workloads. Customers rent access to clusters filled with Nvidia GPUs, high-speed networking, storage, and the software needed to train and run large AI models. The business is straightforward in theory. Buy expensive GPUs, place them inside specialized data centers, connect them together, and rent the computing power to AI companies. The difficult part is the scale. Nebius spent about $5.7 billion on capital expenditures in the second quarter alone. That is almost 10 times its quarterly revenue. Most of that money went into GPUs, related hardware, and data center expansion. This creates a strange financial machine. Nebius has customers ready to pay for computing capacity that does not yet exist. To serve those customers, it must spend billions before collecting years of future revenue. And because AI demand is growing faster than the company can build infrastructure, the solution is to raise even more capital, buy even more hardware, and expand even faster. The new $5 billion convertible offering is designed to help fund that cycle. Convertible debt sits somewhere between ordinary debt and equity. Investors lend money to Nebius, but under certain conditions they can later convert those bonds into shares. For the company, this can reduce the interest rate compared with normal borrowing because investors also receive the possibility of benefiting if the stock rises. Nebius divided the new financing into 2 major parts. About $3 billion of notes due in 2030 carry an interest rate of only 0.5%. Another $2 billion due in 2034 carry a 4.5% rate. The conversion prices are more than 40% above where Nebius shares were trading when the deal was announced. That means investors are effectively saying something unusual. We will lend this company billions today because we believe its equity could be worth considerably more later. Why? The answer comes back to scarcity. AI computing capacity remains constrained. Nebius says customers are willing to commit to large contracts before new data centers are even fully operational. CEO Arkady Volozh has said the company believes it could sell all of its planned 2027 capacity at current commercial terms. This completely changes the risk profile compared with building a conventional data center speculatively. Imagine constructing a hotel. Normally, you spend money building hundreds of rooms and only discover afterward whether enough guests want them. Nebius is increasingly signing customers before the rooms are finished. In fact, customers are doing more than signing contracts. They are helping finance the construction. Nebius expects to receive more than $9 billion in customer prepayments during 2026. That money can be used to fund part of the infrastructure required to serve those same customers. This is an important part of the business model. Instead of funding every GPU with shareholder capital or traditional debt, Nebius is combining several sources of money: customer prepayments, convertible bonds, secured loans, operating cash flow, and potentially equity. In July, the company completed a $775 million secured financing backed by deployed GPU infrastructure and contracted cash flows from an investment-grade customer. That is especially interesting because it shows AI hardware itself is becoming financeable. A rack of Nvidia GPUs is no longer being treated merely as computer equipment. If it is tied to a long-term contract with a strong customer, lenders can begin treating the future payments from that infrastructure almost like the cash flows from a power plant, aircraft fleet, or commercial property. This is the same transformation appearing elsewhere in the AI economy. Nvidia is working with financial institutions to create financing structures around AI infrastructure. Big technology companies are issuing enormous amounts of debt. Data center operators are borrowing against future contracts. Nebius is pushing this model particularly hard because its growth rate requires far more capital than its current cash generation can provide. And the demand side is giving it confidence to keep going. The company has raised its 2026 contracted power target to 5 gigawatts. Starting in 2027, it expects to deploy more than 1 gigawatt of capacity every year. To put that into perspective, 1 gigawatt is roughly enough electricity to power around 750,000 US homes. Nebius is effectively trying to build industrial-scale AI factories. That term matters because modern AI infrastructure increasingly resembles heavy industry. The limiting factors are not only processors. Companies need land, grid connections, transformers, cooling equipment, networking, backup power, construction crews, and access to enormous amounts of electricity. A customer may want 50,000 GPUs immediately, but those GPUs are useless without somewhere to install and power them. This is why companies such as Nebius can exist alongside Amazon, Microsoft, and Google. Hyperscalers have enormous resources, but they also face the same physical constraints. AI labs and enterprises sometimes cannot get enough capacity exactly when they need it. Nebius sells access to that scarcity. Its customers already include Meta and Microsoft, and its infrastructure is built heavily around Nvidia GPUs. Nvidia itself owns approximately 9.3% of Nebius, creating another interesting connection between the companies supplying AI hardware and the companies financing and operating it. But this is where the story becomes more complicated. Nebius reported an adjusted EBITDA profit of $236 million in the second quarter, with its AI cloud business generating almost a 50% adjusted EBITDA margin. That sounds extremely strong, yet the company still recorded a net loss of approximately $190 million. The difference comes partly from the economics of owning billions of dollars of rapidly depreciating computing hardware. Nebius recorded roughly $260 million of depreciation and amortization during the quarter, up dramatically from a year earlier. That expense reflects something investors cannot ignore: GPUs age. An Nvidia system purchased today may still generate revenue years from now, but new generations of AI chips can deliver much better performance and energy efficiency. Nebius currently uses a 5-year useful life for server and network equipment. Whether those assets remain economically competitive for that entire period is one of the biggest questions surrounding the neo-cloud model. This is the hidden risk behind the explosive growth. If AI compute remains scarce, Nebius can charge attractive prices and keep utilization high. Revenue grows quickly, margins remain strong, and the company can refinance infrastructure using future customer contracts. But what happens when supply catches up? Amazon, Microsoft, Google, Meta, xAI, CoreWeave, and many others are building enormous amounts of AI capacity. Semiconductor production is expanding. Data centers currently under construction will eventually come online. If customers suddenly have more choices, rental prices could decline. A company like Microsoft can absorb lower cloud pricing because it also owns software, enterprise relationships, advertising, operating systems, and many other businesses. Nebius is much more exposed to the economics of AI infrastructure itself. That is why the next few years matter so much. Nebius is trying to lock in customers while scarcity still gives it negotiating power. Longer contracts and upfront payments make future revenue more predictable. The faster the company signs capacity before competitors bring new supply online, the more protected it becomes if pricing eventually normalizes. There is also the risk created by financing. Convertible bonds reduce near-term interest expense, but they do not eliminate the cost of capital. If Nebius succeeds and its stock rises above the conversion price, investors may convert their bonds into shares, diluting existing shareholders. The company already experienced this effect after announcing a swap of $800 million of previously issued convertible debt for 15.8 million shares, representing roughly 5.5% dilution. Nebius shares fell almost 10% after that announcement. So investors are watching two very different stories at once. One story says Nebius may be building one of the fastest-growing AI infrastructure businesses in the world. Revenue is multiplying, customers are committing billions, capacity remains scarce, and newly installed GPUs can produce attractive cash flow. The other story says the company needs staggering amounts of capital just to keep growing. It is borrowing billions, issuing shares, spending far more on infrastructure than it currently earns in revenue, and betting that AI compute pricing remains strong long enough for those investments to pay back. Both stories can be true. That is what makes Nebius so interesting. The company is essentially turning the AI boom into a giant infrastructure financing problem. It already knows customers want more compute. The question is how quickly it can transform borrowed money into data centers into active GPUs into contracted revenue, and contracted revenue into enough cash flow to support the next round of construction. Right now, investors appear willing to help. Demand for the new convertible notes was strong enough for Nebius to increase the offering from $4.5 billion to $5 billion. Management argues that this reflects confidence in the underlying demand for AI services and data center capacity, but the most revealing number may not be the amount Nebius just borrowed. It may be the more than $40 billion of customer commitments already waiting on the other side. Because Nebius is not borrowing billions simply because it hopes AI demand will eventually appear. It is borrowing billions because the demand has arrived faster than the infrastructure. And if that demand lasts, the company that began as a relatively unknown AI cloud provider could become one of the largest independent owners of AI computing capacity in the world.